Let's talk about a tax strategy that you should analyze in the year that you become a widow. I'm Elliot Apple, founder and financial planner of Kindness Financial Planning, and today we're going to talk about strategies that you should consider when your spouse passes away. Now, I know this is a difficult time, and it's really tough to be able to do everything that you want to do, and so I'd say only approach these strategies insofar as you have enough emotional energy to go through it, but for those that do, there can be some tax savings that can be had here. So with that, I want to show you an analysis of a sample client. We're just going to illustrate a fact pattern here that could happen in your life, and specifically how to think about Roth conversions in the year that your spouse passes away. So let's jump into it. So as we can see here, looking at 2023 just as a rough estimate, we can see here that this person in this hypothetical scenario had $100 of taxable interest. They don't keep a lot of cash on hand. They do have a pension. They worked for a state government and received $21,000 per year. And then for this year, their gross Social Security amounts was about $47,000. This person's husband passed away mid-year, and so they got some benefits, but not the full year of benefits. And next year, they're just gonna be down to her benefits and the higher of the two. So we can see here that the taxable Social Security isn't very much, and the reason for that is because their income's not very high. Total income's about $27,000, and with the standard deduction here, it actually turns out they're not going to owe any tax, which is a rough estimate. You can see the bracket they're in, but really, they're not going to owe any tax in this scenario. So the question becomes, do we want to just leave it as is for the year, or is there something more that we want to do? Do we want to recognize some income purposefully? In this hypothetical scenario, mostly they have IRA money that's tax deferred, and so they don't have much in the way of Roth IRA money or brokerage account money. They have some cash on hand to help cover some living expenses, but for the most part have been living inside of their Social Security and pension benefits. So with this, we want to see here, does it make sense to do a Roth conversion this year, or do we want to leave it as not having very much in Social Security benefits being taxed? But the one thing that we need to pay attention to first is what happens in tax brackets next year. She's in an interesting scenario this year where the married filing jointly brackets are pretty wide and with pretty low tax rates. So the question becomes, do we want to do a Roth conversion this year? Let's take a look. So here's where we're going to look at what things could look like with income sources in a Roth conversion. So I've copied over all the scenarios here. So $100 of taxable interest, pension stays the same, gross Social Security stays the same, but I've gone ahead and calculated what would bring them estimated to the top of the 24% tax bracket. And in this case, it's about $333,000. And with this scenario, we can see instantly that Social Security is going to be more taxable because Social Security is up to 85% taxable. That's why you don't see the full amount, which is a far cry from where they were originally, where not very much of their Social Security was being taxed. So is this a worthwhile trade-off? Well, we can scroll down and see what their adjusted gross income would be. Still same standard deduction. Taxable income's the same, but total tax would be raised to $74,000, and they're in the 24% marginal tax bracket. If we look at how this actually flows through a little bit visually, we can see here how much is being taxed. So they've got a good chunk being taxed at 10%, then 12%, then 22%, then 24%. And we can see the estimated tax that they would owe and where their ordinary income falls, which brings them really to the top of the 24%. They could convert maybe a little bit more money. So that's one thing that we're looking at. And then what happens to Medicare premiums? Because we want to pay attention to this and be mindful of it, but we don't want to necessarily have this Medicare premium or the IRMAA surcharge dictate what happens. So you'll see here that this brings them pretty close to the top of this Medicare IRMAA bracket, where they will pay more for Part B. You can see that $480 there and some change. They'll also pay more for Part D, their normal plan premium, plus $57. So just want to be aware that if they were to do this in 2023 as an example, 2025 their Medicare premium would potentially be higher. But is that a worthwhile trade-off? Well, in their case, we're leaning to the answer being yes. And the reason for that is if we fast forward and add in a 2024 estimate, and we scroll back up here, in this case, it's going to be a single file bracket. And what I mean by that is if we look at these brackets here, you can see you convert quite a bit of income within that range. You know, $100,000, $172 here. If we fast forward to 2024 and we're back to single filer, we'll notice is this range isn't so high anymore. There's less income that we can recognize in each bracket and stay within that. Going up to 24%, we had 191,000 versus married filing jointly. We go up all the way to 364. And so this is really important to keep in mind that anytime you lose a spouse, you are most likely, in very limited circumstances, can you stay in a more favorable tax bracket. Normally, you're going to go to a single filer the following year. So the year that your spouse passes away, you sort of can, I don't want to say take advantage of, but optimize on these tax rates, having wider room within those brackets to be able to recognize income. And in this case, this person had pretty much all pre-tax money. They had a very small Roth IRA bucket. So they potentially can convert $333,000, pay less than 24% on that, and have that money growing tax-free. And that can be really beneficial for heirs. It can be beneficial for you because it could reduce required minimum distributions. This person now is likely going to be in a single bracket for the rest of their lives, but still have pension and Social Security income. And then once required RMDs start, that could actually push them into a higher bracket. We also don't know what tax rates will do, whether they will be higher or lower into the future. And so looking at this, they can potentially decide to say, hey, I want to recognize this income. I'll pay a lot more in taxes this year. It's an estimate of $74,000 in taxes, but significantly move a good chunk of their pre-tax or IRA money to the Roth and potentially reduce their required minimum distribution later. And if we fast forward to next year, in 2024, what does that look like? Well, same pension income. Social Security is going to be down a little bit just because they're down to one Social Security income, not both. You can see taxable Social Security income is still fairly low. Not all of it's being taxed that could be. Total income, about $31,000. Standard deduction also gets reduced because they don't have that extra person that's over age 65. So taxable income is about $15,000. Puts them in a pretty low bracket and not very much being paid in taxes. Now, they could say, hey, where do I fall within this tax bracket? And if we take a look at that, well, that's going to put them pretty squarely in that 12% tax bracket, slightly above that $11,600. Do they want to convert more money? Well, that may or may not make sense. And if we look at that from a perspective of if they were to convert, say, $10,000 more, what happens to that income? How is that taxed? And we can take a look at that. It actually does something pretty interesting here, where this measures the tax impact of the next $1,000 in ordinary income. You can see the next $1,000 is actually going to be taxed at roughly 22%, not that 12% tax bracket. And you'll see here the reason for that is more of that Social Security income is being taxed. Now that's problematic for the first, call it $17,000 of income, and it gets even worse on the next between roughly $18,000 to $29,000 of income, because in that scenario, they're paying almost 41% on that because more of their Social Security is becoming taxable. So in their case, it probably doesn't make sense to convert roughly $29,000. Now, they could decide, hey, I want to convert up to the 22% tax bracket or the 24% tax bracket, and maybe that makes sense to spread out some of that tax on the Social Security that is happening there. But in this case, maybe they just decide, hey, I don't want to pay very much in tax this year. I'm very comfortable paying, say, $1,500, and I'll have a few years of this where likely my pension and my Social Security income will be low enough and my Social Security is not being taxed very high. And so that's something to pay attention to, that it doesn't always make sense to convert within this bracket because it can play with different income sources. So this is just one example where in the year of death, it maybe made sense for this person to do a large Roth conversion, get some money growing tax-free. They have roughly a split now because the Roth was growing faster using asset location and putting more stocks in that account. That could be one thing that happens. And so they're able to roughly get a half Roth IRA, so half tax-free and half pre-tax. And that will put them in a better position later as they start requiring minimum distributions. It can also be a great thing for heirs when they need to start distributions, when this person ends up passing away. So it's a way to mitigate and hedge potential future tax rates there. So this is one strategy. Consider that if you lose a spouse, think about maybe doing a Roth conversion, do a tax projection. Doesn't make sense. It doesn't make sense for everybody. And it depends on your comfort level with how much you want to hedge tax rates. But you can see here in this example that in their scenario, they were able to convert quite a bit of money, change their asset structure a lot, pay some tax, but it wasn't an outrageous amount of tax considering they'll probably be in that tax bracket later on if they didn't do the Roth conversion. And now they can enjoy a few years of their Social Security not being taxed very high and enjoy a low tax bill. So hopefully this was helpful and you learned something. If you enjoyed this video, hit the subscribe button so you can be notified of future videos. Thanks for watching.